getting into just some of the affordability, some of the economics to the borrower, right? Why would I want an ARM, right? Why would I want this less certainty that I'm going to have this interest rate for a long period of time? And it's payment. It has to make sense to the borrower. The payment has to be significantly lower than what it is on a 30-year. And what could that look like? So just getting into some simple economics of what the difference in payment could be for a borrower. We went back to a couple different markets in history when ARMs were fairly popular. So 2018 was probably the most recent. So we looked at a $400,000 loan. 30-year fixed at that time was about 4.7, 4.75-ish. But ARMs are about 100 basis points less, so call it 3.7, right? So on a $400,000 loan, that would be a difference of about $300. So fixed rate would be about $2,600, and an ARM would be about $2,300. So it's a significant amount. That could cover, in some cases, your insurance or your taxes. So it made sense, again, that we had a decent amount of ARMs being originated in that market. But that took a whole 100 basis points on 400,000 just to get that payment down by a few $100. So if we go a little further back, go to like 05, right? This is when ARMs were screaming. Obviously, there was a lot going on back then pre-financial crisis, but there was, call it 2.5 points difference between a 30-year fixed and an ARM. So 30-year fixed was about 6% back then. An ARM you could get at like 3.5%. And then you're really smoking, right? Then you're talking about the difference between like a $3,000 payment and a $2,200 payment. So an $800 difference, almost $1,000 a month. So really big difference there.